Exchange-traded funds and financial spread betting. Combining financial spread betting with ETFs can give you a way to get exposure to an ever-growing range of sectors, commodities, global financial indices, which you can profit from regardless of markets moving up or down. Exchange-traded funds, or ETFs, have been around since 1993. ETFs are index tracking funds which can be traded on a stock exchange, just like a share. A typical ETF might seek to mirror the performance of an index like the S&P 500 or the FTSE 100, or perhaps a single sector such as the S&P energy sector, XLE, or commodity price such as gold. ETFs have been growing in popularity with investors, both large and small, partly because they can be easily traded, just like any other listed security, and partly because they're much cheaper in terms of the fees they charge compared with conventional mutual funds or unit trusts. So why would you place a financial spread bet on an ETF? Surely, if you're convinced of the merits of ETFs, it would be easy just to buy and sell the physical ETF rather than opening a spread betting or contracts for difference (CDF) account to trade them. ETFs are offered as spread bets for a number of reasons, many of which really boil down to the advantages of financial spread betting. For starters, when opening a spread betting account, you gain the advantage of trading on margin. Your spread betting company will loan you the majority of the value of the trade, while you only need to deposit a relatively small percentage as your margin. This is something you couldn't do with a physical trade on an ETF. It also means you're effectively trading a larger amount of shares in that ETF than you would ordinarily be able to do. And if you're right and the ETF's price goes up, you get to keep all the profit from the trade. Of course, if you're wrong, the losses could be proportionately great, so caution should be used when trading those products. ETFs are easily available via a conventional stockbroking or share dealing account. But like trading physical shares, if you trade physical ETFs, you're liable to a commission fee every time you trade. In addition, you may also have to pay custody fees. With financial spread betting or CDF training, you don't face the drag these costs can pose to your trading account. Plus, you're able to trade other assets like currencies or commodities using the same account, not something that's usually possible with a share dealing account. Financial spread betting also lets you short an ETF. This means you can potentially profit if the price of that ETF falls by using the bid or sell price. This is much harder to do in the physical market. Yes, some providers do list inverse ETFs, that is funds which move in the opposite direction to the index, but these are generally only available for the more high-profile indexes, like the S&P 500 for example. It's much easier to short an ETF using a financial spread betting or CFD account. Interested in learning how to profit from financial spread betting and ETFs? Then it's worth spending some time in getting the facts. Learn from well-known spread betting and trading expert Stanzione. To find out more, go to www.fintrader.net.